Hey everyone, welcome in. So many of you asked for it. Peter Lynch's One Up on Wall Street. Truly a classic. We're diving deep, uncovering how to invest like the legend who led Fidelity Magellan to those incredible returns.
You know, what strikes me about Lynch is how he takes the mystique out of investing. You don't need to be some Wall Street hotshot. Everyday investors, they actually have a built-in advantage in his view.
Right. His whole street lag concept, it kind of blew my mind. Break that down for us, would you?
Absolutely. Picture this. A new store pops up in your neighborhood. You see lines around the block every day. You're in on the secret before Wall Street even catches wind. That's street lag in action. Lynch argues, analysts, by the time they spot a trend, it's old news to the people living it. We've already seen it firsthand.
And we have the edge, like that fireman Lynch talks about, the one who invested in Tam Brands, the company behind Tampax.
Exactly. This guy sees a Tam Brands factory in his town just exploding with growth, expansion after expansion. He's thinking, something big's happening here. Right. He was so right. Sometimes the most powerful insights, they come from just observing, from our own experiences.
Makes you wonder how many potential stock picks have we just let pass us by, right? But Lynch wants us to sharpen that instinct. He even says the perfect company. It's often the one Wall Street ignores. The less flashy, the better.
He's onto something there. Take automatic data processing, for example. It's not exactly a name that gets you excited, right? But that's exactly Lynch's point. Less hype means more time for us to spot the potential and get in before it's the next hot stock.
Okay, but what about those businesses that make you kind of cringe? Lynch has that whole section on disagreeable companies. Waste management, funeral homes, not exactly dinner party conversation.
And yet, often incredibly profitable. Service Corporation International, that's the funeral home giant. It's a perfect example. These aren't exactly industries people love to think about, so they get overlooked, right? Creates an opening for anyone willing to dig a little deeper, to see beyond the ick factor, the take-home. Don't shy away from those companies others find off-putting. They're often more profitable than people think.
This Peter Lynch, he's full of surprises. He also really likes spin-offs, companies that get split off from bigger corporations.
Right. The breakup of AT&T. Nobody caught much of those baby bells back then, just boring regional phone companies. But freed from all that corporate bureaucracy, they took off. Proof that boring can be pretty darn lucrative.
It's about finding the value others miss, isn't it?
Exactly. But to unearth that value, we've got to decode those financial statements. Don't worry, we'll get you what you need. Let's start with the PE ratio, a real Lynch favorite.
Oh, the price-to-earnings ratio. It can feel like some kind of secret code.
Not at all. Think of it this way. Imagine you're at a farmer's market, deciding between two apple vendors. One selling apples for $1 each, the other for $2. You'd want to know which vendor's apples are actually worth the price, right? That's what the PE ratio does for companies. Helps you see if the company's growth is justifying that price tag.
So a really high PE ratio might be a red flag, like those $2 apples better be dipped in gold or something.
You got it. Now let's talk debt. Lynch wants you to make sure a company isn't drowning in loans. He uses Ford as a great example. Even though Ford had loads of debt at one point, Lynch wasn't scared off.
Why not?
He looked past just the debt. He saw those billions in cash reserves, a booming financial services arm. It's like, checking someone's entire financial picture, not just one scary number.
It's all about context.
Exactly. Next up, cash flow. How much cash is the company actually generating? That's what we need to know. Because a company can look great on paper, profitable and all, but if the cash flow is weak, they might struggle to pay those bills.
Like the difference between having money in the bank versus a wallet full of IOUs. Might look rich, but can you actually buy anything with that?
Perfect analogy. And lastly, let's dig up those hidden assets, those valuable parts of a business that the market might be missing.
Lynch's example of store communications always comes to mind. They had all these valuable TV and cable properties, but the stock price, it just didn't reflect that. It was trading way below what those assets were actually worth.
It's like finding a rare first edition comic book tucked away in your grandma's attic.
Yeah.
Those hidden treasures, that's where savvy investors clean up.
Okay, so we found a company, the financials look good, we get the business, but knowing when to sell, that's just as crucial as knowing when to buy, right?
100%. And Lynch, he has a unique take on this too. He's not about chasing some arbitrary target. It's about understanding the company's story and knowing when that story changes.
Okay, now I'm really intrigued. What makes for a compelling company story? And more importantly, when does it start to go south?
Well, for Lynch, it all boils down to understanding the company's fundamentals, its potential for growth, its competitive landscape. If any of those start to weaken, might be time to reevaluate. Say a company you invested in, it starts taking on tons of debt, or the growth suddenly stalls. Red flags, right?
Makes sense. It's like any relationship, right? If the bad starts outweighing the good, you don't see things improving, time to move on, maybe.
Exactly. But here's where it gets really interesting. Lynch also says, think about selling when the company's story is almost too good.
Wait, really? Why sell when a company's doing amazingly well? That feels counterintuitive.
Because when a stock gets super hot, it attracts all these short-term investors just hoping for a quick buck. They can drive that price way up beyond what the company's performance justifies. You get a bubble.
So better to sell high sometimes, even if it's tough, than risk riding that wave down when the bubble bursts.
Exactly. Lynch's whole philosophy is about staying flexible, recognizing those shifts, and not being afraid to take your profits. Investing, it's not about emotion. It's about making smart, informed decisions.
Speaking of smart decisions, Lynch found investment ideas everywhere, right? Didn't he get the idea for Dunkin' Donuts by, well, going to Dunkin' Donuts?
He did. And La Quinta Motor Inns. This wasn't some guy stuck in an office. He was out there observing, listening to his gut.
That street leg advantage in action. But Lynch also says good instincts are just the start. You gotta back it up with solid research.
Absolutely. That's what separates speculating from real investing. He talks about the 2-minute monologue test. Can you explain a company's story, its potential, its challenges, convincingly in 2 minutes or less? If not, you might need to hit the books a little harder.
That is such a simple but brilliant test. If you can't explain it simply, you probably don't understand it well enough to be putting your money in it.
Right. Lynch doesn't just leave you hanging with the 2-minute monologue, though. He gives you this whole framework for categorizing companies, makes research easier. He talks about slow growers, stalwarts, fast growers, cyclicals, turnarounds, asset plays.
Okay, that's a lot of categories. Why even bother categorizing them in the first place?
It's about strategy. Once you know what type of company you're dealing with, you can tailor your approach, set realistic expectations. Like, if it's a stalwart, a well-established, dependable company, like, say, Coca-Cola, you're not looking for explosive growth. You want steady, consistent returns.
The tortoise and the hare. Slow and steady wins the race. Okay, what about those fast growers then?
Now, there you're accepting more risk in exchange for the potential for higher rewards. These are your younger companies, often tech-focused, huge potential, but more uncertainty too. You're looking at things like rapid revenue growth, innovative products, a strong leadership team.
Then there are those companies that are kind of like a roller coaster, those cyclicals.
Right. Heavily influenced by those economic upswings and downturns. Think airlines, automobiles, housing. The play there is to buy them when their industry is down and sell as the cycle starts turning back up. Of course, timing that perfectly is the tricky part.
Sounds like Lynch, he likes finding opportunity where others aren't looking. Like with those turnarounds, companies that have hit a rough patch but are showing signs of life.
Exactly, like finding a diamond in the rough. Right. Take Chrysler. They were on the verge of bankruptcy back in the late 70s, then boom, incredible comeback. Turnarounds can be risky, sure, but the potential rewards, if you pick right, are huge.
And we can't forget those hidden assets we talked about before, the asset plays.
Ah, yes. Finding a dollar for 50 cents. The company's sitting on valuable assets that the market is undervaluing. Lynch even admits he missed out on a classic asset, play Pebble Beach golf links.
Pebble Beach? Seriously, how could someone with his track record miss that?
A cautionary tale. He had the chance to buy it back when it was a public company, but he got so caught up analyzing these messy financials, he missed the obvious.
Which was?
The real estate.
Yeah.
Pebble Beach wasn't just a golf course. It was prime real estate, incredibly valuable land. He focused on the trees and missed the whole forest. It just goes to show even the best investors make mistakes. What sets them apart is they learn from them.
Sounds like Lynch, he's all about self-reflection, constantly learning. So if we're thinking about key takeaways, what should investors really keep in mind?
He stresses patience, thinking long-term. Investing, it's a marathon, not a sprint. Don't sweat those short-term market swings. Focus on finding good companies, holding on for the long haul.
Makes sense. It's so easy to get caught up in the hype of a rising market. Or the panic when it's falling.
It really is. But real wealth, it's built gradually. Don't check your portfolio every day. Focus on the fundamentals. Trust your research.
So tune out the noise, stay the course. I like it. But even with the best research, the right mindset, knowing when to sell, that's crucial. Lynch has some really smart advice on when to say goodbye to a stock, even if it's been a winner for you.
He says, forget those arbitrary targets. It's about, recognizing when that initial story that drew you in, when it's starting to change.
So for a stalwart like that Coca-Cola we were talking about, what would signal a shift in the story?
Well, a few things. Maybe they start racking up debt, or growth just stagnates, even with their solid track record. Or that PE ratio, it gets out of whack. Stock price going way up, but earnings aren't keeping pace. Could mean a correction's coming.
Like that saying, right, what goes up must come down. What about those fast-growing companies, though? Those must be tougher to let go of.
You'd think so. But even with rapid growth, you can still get warning signs. Maybe their expansion hits a wall, new competition pops up, throws them off course, or they get acquired, bought up by a bigger fish.
Which, hey, that's not always bad for investors, right?
True, a buyout, it can mean a quick profit, but then you lose the chance for those long-term gains if the company had stayed independent and really taken off. Trade-offs.
Now, those cyclical businesses, the ones tied to the economic roller coaster, those seem like a real challenge.
For sure. Lynch says selling as that cycle starts to turn down, that's key. But calling that turn, that's the tricky part. He says keep an eye out for things like rising inventories, or when commodity prices start to dip, early indicators that the party might be winding down.
It's all about spotting those subtle shifts, being ahead of the curve.
You got it. And asset play, remember those companies where the value is all about their underlying assets? Best time to sell there is often when a corporate raider comes sniffing around.
A corporate raider sounds kind of intimidating.
They're like corporate takeover artists. They swoop in on these undervalued companies, buy them up, often take them private. It can be a big payday for investors who got in early.
So you're riding that takeover wave, selling at just the right moment.
Exactly. Now, even armed with Lynch's insights, we can still fall into those classic investing traps. He warns about getting spooked by those temporary dips, selling off a good stock too soon.
Or the flip side, right. Hanging on to a loser for way too long, hoping for a miracle comeback that never happens.
It's so tempting to do that. Lynch is all about cutting your losses, let those winners run. And he has this great line. He says, a stock doesn't know you own it. It's like this reminder, right? A company's performance, that's what matters, not those day-to-day market jitters.
Tune out the noise, focus on the fundamentals, don't panic. Sounds like pretty solid advice for life in general.
It really does. And, you don't have to be right every single time to be a successful investor. Even Lynch, he missed out on some big winners. It's about having a solid process, doing your research, and being open to learning from those missteps,
That is a comforting thought. So as we wrap up our deep dives into One Up on Wall Street, what's the one big takeaway you hope listeners walk away with? What's that Lynch wisdom?
That anyone can do this. You don't need a fancy degree or some secret handshake. Just put in the work, trust your gut, and invest in what you know. You can be a successful investor.
It's about taking control, right? Empowering everyone to build their own financial future.
That's it. And One Up on Wall Street, it's the roadmap. It's timeless.
Well said. We hope you found some inspiration today to go out there, find those hidden gems, and, build that financial success. It's a journey, not a race. The most important step is the next one. Until next time, happy investing, everyone.